This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Hey, Jason, this is Scott Crook. I was on the Empowered Investor Zoom call last night and just so thankful for the value that's created inside that group. And, you just consistently bring subjects that are so important and relevant to what I'm needing and I believe other investors need. So thank you so much. I appreciate you and all that you've done for helping us become better investors. Thanks, man.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Greetings, empowered investors and those who want to become empowered investors. This is episode 2158. We got a great show for you today. Sean O'Toole is back from Property Radar with a whole bunch of data that is going to make your investing more profitable and help you avoid pitfalls. So many people keep talking about the real estate market and why it hasn't crashed and why it hasn't changed. We have discussed this just beyond, it's like we keep talking about it, but we've got to keep talking about it because it's what's in the news. And this is an interesting piece, if I didn't mention it to you before, and that is how mortgage holders gained $1.6 trillion in equity in 2023. Now, there's a big change coming about this because these mortgage holders that have all this tappable equity, as they call it, it's going to become a lot more tappable at very reasonable rates, and it's going to give people the opportunity to keep their existing very low interest rate mortgages. This is going to be huge, big news for the real estate market. The highest year-end total on record, which is that $1.6 trillion gain for a total aggregate of $16 trillion in gained equity, right? Look at this, the highest year-end total on record, 2/3 of which is held by borrowers with credit scores of 760 or higher. Now, those of you who don't know, 760 is a very high credit score. 720 is good enough. That's a good credit score, but 760 is a phenomenal credit score. By the way, you know what I've always said about this? If your credit score is too high, because I do see people bragging about this on social media, they'll post pictures of their credit score and they're bragging about it. If your credit score is too high, that means you're not using enough of your credit. And credit, just like equity and property or money stuffed under your mattress, is an unused asset. So make sure you're using it, right? You want to have a good credit score, but not such an incredible score that Dave Ramsey would be proud, because he, when it comes to investing, is completely clueless. He is just clueless about investing. But as I said, to be fair, to give Dave Ramsey credit, he is very good for the audience he serves, the audience of people who have massive credit card debt, who are spending money on the appearances of wealth rather than the creators of real wealth. That's where Dave Ramsey's audience is, and he's good at speaking to that audience. That goes up to, we'll call it elementary school. So when you want to graduate from elementary school and go to junior high or high school or college or, get a PhD in investing, you leave Dave Ramsey. You've already solved those basic problems and you move on to true investing techniques, which one of them definitely involves using leverage prudently and properly to make your real estate portfolio perform even better. The average mortgage holder now has $299,000 in equity, $193,000 of which is considered tappable and could be withdrawn while still maintaining a very healthy 20% equity stake, meaning they would have an 80-20 LTV, loan to value ratio, if they tap that equity. That's if they tapped it. There is so much equity in America right now. Can you imagine? And I'm about to report on this, okay? But the floodgates are about to open on this equity. Now, to some that may sound bad. Well, isn't this reminiscent of the Great Recession and people using their homes like ATM machines? No, it is definitely not the same thing. Why? Because number one, we have a housing shortage now. Number two, the loans are extremely well underwritten. Look at these credit scores. Look on the screen here, okay? It says low credit score originations. There have been very few low credit score mortgage originations. During the housing bubble, okay, we're talking about the Great Recession there, many of the low credit score loans were made through the private labeled securities market. Remember I talked to you before about Louis Ranieri, right? Someone nobody talks about, but that's the guy who basically taught the world how to securitize mortgages in the early 1980s. And that was game-changing. It was world-changing, for better or worse, right? Because we saw there was tons of corruption on Wall Street, as there still is tons of corruption on Wall Street, and people abuse that system. But overall, that allowed the mortgage market to massively grow and the real estate market to massively grow. So we have what we have. That's what we have. So here we look at this chart and we see during the Great Recession and leading up to it, 2003, 2004, 2005, 2006. I mean, in 2006 alone, there were 4 million low credit score mortgages originated. Before that, there was about 3.7 million the year before and about maybe 3.8 million the year before that. And then even in 2006, you had almost 4 million again. And then 2007, the lenders started to worry, as they should have much earlier. You had just about 2.6 million of those mortgages originated. So add all of those up, right? That's going to be about, I don't know, almost 20 million, right? I don't have a calculator handy. Hey, folks, this is harder than it looks doing this off the cuff. Okay. And you see that was a massive number of low credit score mortgages, not to mention low equity mortgages, not to mention liar's loans with no income, et cetera, right? These are all credit scores below 660 FICO scores. But since then, there have been very few of those low credit score mortgages. And especially last year, there were less than 400,000 of them. Suffice it to say, the mortgages are very well underwritten. And if you've applied for one in the last 15 years, you know this to be true because they wanted to know your shoe size, your bra size, they wanted a DNA sample, they wanted everything, okay? They wanted to know everything before they would give you a mortgage. So completely different world nowadays. And we'll talk about that a little bit with Sean O'Toole here. So let's go ahead and get to our interview with Sean. You're going to love this. Here we go. It is my pleasure to welcome a returning guest back to the show, and that is Sean O'Toole. He's the founder of Property Radar, formerly Foreclosure Radar. He is going to give us some great insights into the market and into advertising and into what are property buyers, especially wholesalers, what are some of their techniques nowadays that might surprise you? So let's dive into this topic. Sean, welcome back. How are you doing?
I'm doing great. Thanks for having me, Jason.
Good to see you. So where do you want to start? Maybe with just the 30,000 foot view of the marketplace and what's going on out there. Just, the overall elevator speech, I think would be a good place to start.
Yeah, I think, I don't know that I have much unique to add, right? We are seeing inventories increasing a little bit finally this year.
Not enough, though.
Not enough.
Yeah.
Some folks that think with the additional inventory, we'll see more sales. We've also seen, interest rates tick up a little bit. So that could mean less sales. I think big picture, we're going to stay in a fairly low sales volume environment until something, significant changes in the market. And we're likely to see, I think inventories continue to creep up a little bit as folks decide to sell. The other, the huge thing is that we have so many folks locked into a low mortgage rate, and that puts a lot of pressure on them to stay in their home rather than to switch homes or, transact like they might normally otherwise. Even if they need to move for some reason, they're likely to keep that house and rent it out versus sell it. So those are some of the things, that I think are really going to keep a lot of, both on the supply side, It's hard to let go of that great mortgage rate and sell. And on the buy side, it's hard to pay these new mortgage rates and buy. So I think lower transaction volumes is the big picture. Maybe a little better this year than last year, but still.
Yeah, but still overall the trend being low inventory, lower sales volume. When you have low inventory, you have low sales volume automatically because you don't have enough to sell. And then you have, of course, demand destruction thanks to the high interest rates. So demand is
high
lower.
prices.
Yeah,
I mean,
right.
the high prices are actually worse than the high interest rates in terms of demand destruction. I mean,
Tell us about that.
prices now versus 2019. I mean, it's just insane in a lot of areas how fast prices moved up, and they really moved up to unsustainable levels that are a bubble. I don't think it's a bubble that'll burst because we've removed the mechanisms for bursting bubbles, but maybe it'll.
Okay, I got to ask you about that. So it's interesting. You made the remark, high prices. We saw prices go through the roof, obviously. And then you said it's unsustainable. But interestingly, it seems to be not only sustaining, but continuing to appreciate. And Sean, that's one of the things I've been saying. What other asset class could you literally triple the cost of money? Where the mortgage rate is essentially tripled, I mean, from the very bottom, yet prices continue to increase. That has surprised the doomers and the gloomers and the crash bros like crazy, and so that's surprising. Maybe comment on that. But then the other remark you made.
So there's a difference between value and price. So if we all had to just clear the decks, we all got rid of our homes today in our neighborhoods, and we had to rebuy those homes. The people that live there could not rebuy their homes at their current prices.
True.
Prices would have to fundamentally fall. What people that live in an area can afford to pay for a home, to me, is the value of the home, right? Price is what three idiots recently paid.
I love it.
Right? So, because it's the sales comparison approach, to appraisal. It's just three comps, maybe four, maybe five, but it's just a few recent sales. And so you get in a position like this where prices make no sense for the incomes in that area, right? The value's not there, but I need to live there and I'm moving from somewhere else, which has the same thing. I can bring that funny money over and overpay.
Meaning the equity.
Yeah, the equity. But, it's in 2006, we had really high prices, right? And people were like, oh, my home is an investment. It's worth this, right? And this is where, there's a piece here about investing, and I'm not anti-investing. I don't think it's even now is necessarily a bad time to invest. But this idea that price, has something to do with our net worth, right? So we saw people's net worth in 2006 go from here to 2008, 9 down here. But the fundamental value of that house as housing didn't change at all during that period of time, right? It still served the same purpose. It served the same value for us. And so unless you were a buyer or a seller, nothing really changed. And if you bought in 2006 at that peak and you could afford the payment, it served as great housing for you, even though your price went way down. And it's now a good investment again. It just took a little while. So if you're investing, what you want to look at is what's the cash flow, and just forget price. If you go to sell at a time when appreciation is great, that's the icing on the cake. I think the value of investing is that cash flow, that return that you get. And by the way, you have an asset where rents go up over time with inflation and value of the property should come up over time. And as a home, can you afford to live there? And do you like to live there? That's all that matters. All our fascination with price is just, unless you're buying or selling right now, is misplaced.
Okay, so our fascination with prices is misplaced. It's misplaced why? Because we're acting like speculators, or we're expecting prices to go up, or what? Just unpack that more.
So right now we have, the median price in my little town is now $1 million, right?
And you're up in the Lake Tahoe area.
Lake Tahoe area. It wasn't that long ago. It was $500,000.
Okay.
Right?
So it's doubled.
It's doubled, right? So if you live in Lake Tahoe and love living in Lake Tahoe, what does that do for you? Right? It allows you to borrow some money and put yourself in debt. It allows you that. It allows you to sell, but if you sell, you're just going to lose money on the transaction if you want to buy back. You can sell and leave the area, right? But if you love being here, what does it really do for you that prices have doubled? If anything, it's put pressure on property taxes. Fortunately, here we have Prop 13, which limits how much
They're on the California side. Yeah. Okay.
can increase a year. But what does it change if you suddenly run around, well, I've got $500,000 of net worth, of extra net worth, and you start spending like you have that, you're just going to get yourself in trouble.
Yeah, so here's the thing. Your argument, on its face is accurate, I think, but it's always been that way. And granted, it hasn't always been that way in such a short time span. The time span might have been longer, but the concept is exactly the same. And really, it's an argument that it's just the value of the dollar has changed. It's just inflation, okay? Because now
we haven't had 50% inflation over the last 4 years.
Well, all I'm saying is consumer price inflation versus asset inflation are different things, right? Those don't go evenly, as we know. But the wealth effect is there, and it has outpaced consumer prices. So those people do really have more money to spend, right? The people that owned real estate dramatically outpaced the people who didn't. Okay,
absolutely.
They got a huge perk. There's this economist that we all know about from 250 years ago or so, Cantillon, right? The Cantillon effect. The people closest to the money printer get the benefit of the money printing first and most. And so you could argue that every homeowner with a mortgage, especially because the inflation has debased the value of that debt, every homeowner got the Cantillon effect. They were closer to the money printer, right? And every investor multiplied that effect because not only did they have their own house probably, but they had multiple investment properties. And if they were leveraged, that really...
Don't misunderstand me. I'm not suggesting people sell their house, take their chips off the table and go rent, right? But what we just saw is very similar, but opposite to what we saw in the 2005 to 2009 timeframe.
Okay.
Right. So we saw a huge decline in values in that time. And a lot of people thought, oh, you're an idiot for owning real estate during that time. And again, if you invested in real estate in 2005 and 2008, you look like an idiot. But over 10, 20 years, the wealth effect, right? If you're slowly adding dollar cost averaging, whatever, you're building your real estate, even the real estate you bought in 2005 has now worked out to be a great investment.
Well, the interesting thing, too, is you might have thought you looked like an idiot investing in real estate, but the question nobody asks is you can't hear the dogs that don't bark. What else would you have invested in instead? The stock market took a dive. Precious metals didn't even perform well, surprisingly. Everything was decimated, right? Businesses were decimated. The stock market, nothing performed well during the Great Recession, right? In fact, I would argue that leveraged real estate actually performed the best. Oddly, most people didn't think that way because they have a hard time understanding the multidimensional benefits of the real estate. But,
in 2005, you bought a property that had a 5 cap, and you took advantage of depreciation and other things, the other benefits of owning real estate, right. You did great.
Yeah.
And you still got your 5% return. Now, if you bought speculatively in 2005,
and in the stock market, you might have lost 40%.
Counting on future appreciation. And I think that's right now. Like, if you do good fundamental investing right now, I think it's a great time to invest. Mm-hmm. I would not be doing speculative investing in this market, counting on more appreciation like we've seen the last couple of years.
Yeah, well, that's goes without saying. Couldn't agree more. If you're going to be a speculator, that should only be a small portion of your wealth, 10%, maybe 15 or 20 in the more bull market attitude. But, don't speculate with your main thing, right?
But this is a huge thing, so the run from 2000 to 2005 was also a very quick run up, kind of like we've seen the last handful of years here. And you had a lot of people that were buying in 2005 speculatively. I remember I sold a home to, and I actually tried to talk them out of it, in Stockton, California, epicenter of the foreclosure crisis. He worked in the fields and she was a maid, and they were buying a $400,000 home in Stockton, and they clearly couldn't afford it. And I just said, hey, listen, you shouldn't be buying this house, right? I basically tried to talk them out of it. And they're like, but our brother made $100,000 last year. Our uncle made $100,000 last year. Everybody's making money in real estate except us. And so we're going to buy now with the idea that that's going to happen for us over the next year. I don't think this is that moment.
what you alluded to earlier is how appraisals use three comps, right? And obviously, residential real estate is sold by the comparison approach. And you said that's just a reflection of what three idiots agreed to pay. And yes, you could argue that that's just the greater fool theory, right? Which states, no matter what I pay, some greater fool will come along and pay more. And that's essentially a game of musical chairs. And we've seen how that ends sometimes. But if you're in a market where you have a lot of inflationary pressure in the system, you have a shortage of housing, and you have no path really to create any significant amount of new housing inventory, and you have 15 years of a lack of building, especially of entry-level housing, and you have 15 years or more of really strict underwriting guidelines on mortgages. We have all those things.
Yeah.
Are you a greater fool? It seems like prices are high. I couldn't agree more. But
yeah,
are they in danger of falling in any real way?
So let's get to that. Are they in danger of falling in any real way? So if we roll back the time, roll back to 2005 when I sold all my real estate assets, right? And it was high prices, slowing sales, looks a little bit like today, and certainly looks a lot like last year. Why didn't I sell everything last year? And I did sell everything in 2005.
And why didn't prices go down last year? They went up, right? Yeah, but go ahead.
Well, they still were going. So I'm going to sidetrack on that for a minute, right? So one thing you have to keep in mind is we look at median prices. I sold all my real estate in the Central Valley of California at the beginning of 2006.
Okay.
Across the board, at all price points, prices were falling through all of 2006. And across the board in 2006, median price was going up. Doesn't make any sense, does it?
Okay.
It's true. It's a fact.
Right.
Why did that happen?
But that was only 2006. It wasn't 2007 and 8.
Right. But in 2006, prices were falling and median price was going up. And everybody was saying price is still going up. What happened?
Yeah. Well, we got to remember median and average are obviously different things. Median is just the middle. Right. And so, if you have a market skewed toward more high-end properties being built and sold and coming up as inventory, that's going to, influence the median price. If it's a market where you have more low-end and selling and being built, that's going to influence the median price too. Obviously, those influence the average also, but they influence the median more. Right.
So you need to be very careful when you say, oh, the median price is still going up. That doesn't necessarily mean prices are going up. So it's just a little cautionary note, right? That there can be time where people are like, hey, prices are going up, and they're not, right? Yeah. And certainly not at all price points either. So it is good to look at, you had Mike Simonson on. He's got his thing where he breaks it down by quartiles and shows it's still medians, but it does show a little bit more of what's
a little bit more clarity when you do it that way.
More clarity, right? Yeah. Just got to be a little careful there. Mm-hmm. So why did I sell in beginning of 06 and didn't sell last year? And the reason was the regulatory framework in 06 was that banks had to get bad assets off their books as quickly as possible. And so as we started to see foreclosures come up, it was clear that banks would sell those at any price to clear them.
Yeah.
And that actually...
And they were being pressured to do that by the government, right?
They were required by the government to do that, right? And so that was actually the regulatory framework at the time. Post 2009, that regulatory framework has changed to keep homeowners in their home at any price, right? So not that we're going to have no foreclosures, but we're not going to see a repeat of what happened back then. So the question I always ask, once prices go up, prices are very sticky, right? Us owners don't want to sell for less than what Zillow said our house was worth last month.
Right.
So it becomes very sticky. So you need some sort of distressed seller in the market that has to sell, that forces inventory on the market, that forces prices down. And that's what I don't see in this market right now. And I think that's why prices have been as sticky as they are. I think it would actually be healthier for the market, healthier for realtors, healthier for everyone if prices drop by 20 or 30%. But I don't think it's going to happen because there is not a distressed seller anywhere right now, especially with so many people locked in with low interest rates.
Yeah, you're exactly right. I mean, 25% of the country has a mortgage at or below 3%, 65% of the country at or below 4%. These people are extremely comfortable. And Sean, that's what I always say, I keep beating this drum, that there is
something like 40% now are free and clear.
Yeah. Oh, no.
It's an unheard of number of people that own their home free and clear.
Right. And so they have no pressure. The people with the low rates and lock-in effect and the people with free and clear homes have zero pressure. And I always say the one ingredient you absolutely positively must have for a real estate crash is tens of millions of distressed homeowners who become millions of distressed home sellers. And we have the complete opposite of that. Yeah. So the people that control the inventory are extremely comfortable. And one of the things I've also been talking about a lot is how the doom and gloomers got it so wrong. When interest rates went up 2 years ago, they were focused on affordability, and they were right. Affordability got terrible. I mean, affordability still is terrible. It's the worst it's been in 4 decades. But that's not what matters. What matters is not new entrants coming into the market. And interestingly, just as an aside, new entrants are coming into the market. I mean, something like 58% of the market now is first-time buyers.
Well, we've got a demographics issue there, right? We've got millennials, and those millennials are getting supported by their baby boomer parents who have $80 trillion
in wealth
to pass along to their kids. And so,
what economists never understand is that eventually, I mean, look, people may complain, they may resist for a while, right? And they did that, and they have been doing that for almost 2 years now. They say, oh, well, housing has become so unaffordable, and it used to be so affordable during the COVID era, right? But that was an anomaly too. That wasn't reality either, okay? And so the delta got really big between their old expectations and the new reality. But eventually, Sean, what they do, what everybody does, because we're all human, is they eventually just capitulate. They eventually just realize, look, this is the new reality. It's not going to change. It's not going to get any better anytime soon. I got to move on with my life. I want to buy a house. I want to start a family. I can't live with my parents forever. I mean, that's the millennials, right? And Zoomers. And they just get on with their lives, and they adjust their expectations downward to what they can get. And that's what's happening.
And the crash bros also are, I think we have not historically had this level of inflation and other things. And so they'll look at things like credit card debt and go, oh my gosh, look at this increase in credit card debt. Yeah. Right. But if you adjust that credit card debt for wage inflation, so people can afford more credit card debt, and then you adjust it for the cost of the goods, right? I would actually argue that our credit card debt's probably lower than it's historically been right now.
I would agree with you. I'm so glad you said that.
Chart on Twitter, right? That's a scary looking chart on Twitter that, oh shit, we're in trouble. Yep. But you have to adjust these things based on, kind of where things are at now, where wages are at now, et cetera, where incomes are. So, a lot of the things I see from the crash bros, as you call them, it's just bad analysis.
Yeah, it is. It's very surface level, shallow analysis. And, I'm so glad you said that about the credit card debt. And if you look at overall debt, of course, they've got the same kind of arguments about auto debt and so forth. But look, a lot of people really are just skipping the whole car ownership thing too, right? You really don't need a car the way you used to must have a car, okay?
Depending on where you live.
Yeah, of course, but we have a lot of on-demand options nowadays that weren't there before. I mean, look, I'm currently in Arizona where they have these driverless Waymo cars running around. I downloaded the app. I can't wait to get in one of them. I'm going to do it today. Now,
awesome.
Hopefully I'll still be alive tomorrow.
The odds are good.
Yeah, and they're cheaper than Uber. And they're cheaper than Lyft because they have no driver, right? And so they're really quite cheap. Like I last night, I was on my phone, I was looking at their app, and I was looking at some routes, and I was thinking, mostly when I go to a city now, I don't bother to rent a car anymore. It's just too much hassle to wait in line and rent a car. I just take on-demand services around, and I find that it's much easier, much cheaper, and it's just really a better way to go.
And we'll be back with a lot more on this topic with this guest on our next episode.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.